Let me show you a super simple stock picking strategy that beat an S&P 500 index after every test period of 5, 10, 20, and 30 years. So does that mean we just forget about ETFs and just buy the biggest stocks? Not necessarily, because while historical testing can tell us which strategy eventually made more money, it doesn't completely capture what it is like to actually live through the journey. And that's where investor mindset becomes very important. How does this experiment work? We're going to create two investors. For simplicity, we'll call them ETF and stock. ETF takes a simple approach. Every month, the ETF invests $1,000 into SPY. Stock instead invests into individual stocks. A small detail is that stock takes the previous year's 12 largest S&P 500 companies. For example, throughout 2025, stock invests in the 12 largest companies based on the rankings known at the end of 2024. This is an important distinction because in Jan 2025, the investor cannot somehow know which companies will be the largest S&P 500 stocks over the course of 2025. Therefore, to keep it simple and accurate, we assume they purchased the previous year's top 12 stocks, essentially taking into consideration the lag in purchase. Stock invests $1,000 into one of those 12 companies each month, so by the end of the year, all 12 have been purchased. Then the list is refreshed using the latest available rankings and the process repeats. The exact purchase order isn't intended to time the market. The strategy is simple. Buy the biggest companies known at the start of each year and gradually invest in all 12. So both ETF and stock contribute $1,000 per month and make 12 purchases per year. And we'll compare them over 5, 10, 20, and 30 years. Let's start with 30. We begin in 1996. ETF invests $1,000 into SPY every month. Stock, meanwhile, purchases the previous year's 12 largest S&P 500 companies and then updates that list each year. And after 30 years, stock finishes ahead. That's already interesting, but now let's shorten the time period. Over 20 years, we use exactly the same rules. And again, stock wins. 2 from 2. Now the 10-year period. Same contributions, same 1-year lag, same stock picking rules. Stock wins again. And the advantage is larger. That makes sense when you consider the extraordinary performance of some of the largest technology companies over this period. Because stock deliberately concentrates more money into the biggest companies, it captures more of those gains than an ETF, spreading money across hundreds of businesses. So now that's 3 from 3. Finally, 5 years. And once again, stock wins. So across every period I tested, 5, 10, 20, and 30 years, the stock picking strategy finished ahead. At this point, you might reasonably ask, why would I want the ETF? Why not just buy the biggest companies? After all, some of these businesses seem almost bulletproof. But this is where I think the experiment becomes much more interesting, because we've answered which strategy finished with more money, but we haven't answered, could the investor actually stick with it long enough to get that result? Let's return to the 30-year test. But instead of jumping straight to 2026, imagine actually being the investor starting in 1996. You don't know the dot-com crash is coming. You don't know the global financial crisis is coming. You don't know COVID is coming. And you certainly don't know that decades later, huge technology companies will dominate the market. All you know is what's happening to your portfolio right now. And stock gets off to an excellent start. By around 2000, stock is more than 30% ahead of ETF. Imagine how convincing that would feel. You've spent years picking individual stocks and the strategy is working. Then the market turns. The dot-com bubble bursts. Technology stocks fall. And suddenly those gains begin to disappear. Remember, you aren't looking at a completed 30-year chart knowing markets eventually recover. You're watching your own money fall. That's a completely different experience. This is where behavioral finance becomes important. The Journal of Banking and Finance published a great article with some key economic theories around investor behavior and talks about common investment theories. Let's run through a few of them over the 30-year example. One influential idea is prospect theory. People don't necessarily respond to gains and losses in a perfectly rational way. Once you've built up substantial gains, losing part of them can feel particularly painful. So investors can tend to sell out at this point. Then there's salience. During a market crash, frightening information becomes impossible to ignore. Falling share prices, recession headlines, bankruptcies, financial instability. Long term historical trends are quiet. A 30% fall in your portfolio is not. And this creates a very simple problem. A strategy can work perfectly over 30 years, but if the investor abandons it in 5, then they never receive that 30-year return. Now move forward to around 2013. This time, the challenge isn't a dramatic crash, it's a persistent underperformance. For roughly 6 consecutive years, ETF remains ahead of stock. Think about how long 6 years is. You're selecting individual companies, accepting more concentration, and putting in more effort. Meanwhile, someone simply investing in SPY every month is ahead of you. And remember, you don't know what happens next. You don't know that large companies will take off and push stock back ahead. You simply know your strategy has been losing to the easy alternative for years. That's where comparison and loss aversion can become powerful. Even if your portfolio is making money, seeing another strategy outperform can still feel like losing. If you make 50%, but your friend makes 70%, your 50% gain suddenly feels a bit different, and the temptation to switch strategies becomes stronger. So, which strategy is better? Mathematically, the result of the experiment is straightforward. Stock won every historical test that we've done today. And that's useful information. But there are really two different questions here. The first is, which strategy produced the highest return? The second is, could you actually follow that strategy through the entire period needed to achieve that return? Well, that answer depends on the investor. So, a strategy with a slightly lower return that someone can actually follow consistently for decades may ultimately be more useful to them than a theoretically superior strategy they abandon after a few difficult years. ETFs are generally easier to follow because, at the very least, investors know they are matching the market performance more or less. Remember, a spreadsheet doesn't panic during a market crash. It doesn't compare itself with friends. It doesn't get frustrated after 6 years of underperformance. People do. And I think that distinction is especially important today when we're constantly hearing predictions about the next stock that can double, triple, or increase fivefold. Maybe some of those predictions will even be correct. But finding the winner is only part of investing. For example, you may have a few people you know that invested a lump sum, say 10 or 15 years ago in Nvidia, but you will likely know close to no one that has seen a 350 plus increase on their investment. So actually staying invested long enough to receive that return is something completely different. If you want to see another strategy put to the test, watch my momentum investing versus the S&P 500 video next. Or for something different, check out my video about Berkshire's unique investment strategy, which led to a return of over 6 million%.